Today's Bitcoin Weekly Update is with Will Clemente, the lead insights analyst at Blockware. Will and I have a great conversation. We talk about everything from reflexivity to market sentiment to a number of various quantitative data points. I really enjoyed this conversation with Will, and I hope you guys enjoy it as well. Don't forget that these episodes every Saturday morning are brought to you by FTX. FTX got super cheap fees, sometimes as much as 85% cheaper than their competitors. Go check out FTX by clicking on the link in the description. Now let's get into this episode with Will. I hope that you guys learned quite a bit from it. Will, what's up, buddy?
Yo, how's it going, gents?
The young wizard. What's up, dude? We're super excited. We got a whole bunch of stuff to talk to. Before we jump into charts, what's your general read right now on kind of market sentiment? It feels like people were real scared 2 weeks ago or so when all the contagion was kind of taking its toll. Now it feels like people got a little bit more relief and might not be as scared. Is that your general sense?
Yeah, I mean, I would say that, perhaps rightfully so. Some of the fear that we've seen over the last few weeks has been the most extreme that I've ever personally experienced, maybe rivaled by like the COVID crash. I mean, I remember during the COVID crash, people were wondering if the fundamental Bitcoin protocol had like broken or something, because we just had gone down like 50% in a day. But I mean, it has been pretty wild. I mean, every single entity that appears to have been kind of the adult in the room turned out to just be degenerates like the rest of us. So yeah, I mean, I think some of the fear has been, rightfully warranted, but that doesn't mean, I think a lot of the flushing out of malinvestment and leverage that we've seen over the last month or two will be very healthy for the space long term. And, I think a lot of people have been saying, oh, well, this hurts the credibility of the asset class. People aren't going to want to touch this thing with the 10-foot pole because, we've got all these, Ponzi-nomics in the space and all that kind of stuff. I mean, I think, when I've at least spoken to some of these, traditional finance entities that, I don't have a very large circle of, but I would say, a handful of these individuals that I've spoken to, they seem to, be more excited about this than anything because they've seen this, happen many times in the traditional landscape. I mean, for example, like, what happened with 3AC, you've seen that take place in traditional markets. I mean, that's not anything that's unique to crypto. So I think some of these guys are kind of starting to get excited about basically buying distressed assets in a marketplace that's experienced a tremendous amount of forced selling and is in a state of, tremendous amount of fear. You've got a lot of, crypto native people that are now questioning even the viability of the space, perhaps, not on the magnitude of what took place in 2018, but certainly are starting to see some of that.
Yeah, it's pretty interesting when you start thinking through how a lot of this balances out, and your references back to 2020, 2018, in bear markets before. I think a lot about there's just more eyeballs. Like I was trying the other day to figure out a good way to analyze it. 50% of all Bitcoin and crypto investors weren't here for March of 2020. Like that was my general guess, right? And maybe I'm off plus or minus, 10, 15% in either direction. But like a very large percentage of people who right now, this second, hold a crypto asset were not around in March of 2020. An even bigger percentage of them weren't around in 2018, right? And you just kind of go all the way back. And so it's like, I don't know, take the like second bear market, it was 2013 or whatever it was, right? 3%, 1% of all people in the market today were around for that. So it's just like so many people are new, they don't have the context of 2020 or 2018. And so, of course, the market cycles to some degree will repeat because those people have to kind of be indoctrinated into what happens as well, right?
Sure. Yeah. I mean, I think part of why Bitcoin cyclicality is so reflexive is because it's such a new asset class. So every cycle, when we run up in price, it's basically like a massive marketing campaign for BTC and the broader crypto market as well. You get a tremendous amount of new users because Bitcoin just hasn't reached saturation. I mean, we did our user adoption, came on here and talked through that report. It's a very, very small portion of the world actually, has any ownership of Bitcoin or any other crypto asset. So every single cycle you get a new amount of new magnitude of new market participants. And on the move down, some of those people get flushed out and capitulate as they come to the realization that they really have no fundamental understanding of the asset that they're holding, why they're holding it aside from the fact that the price is going up. And you can see this in the data as well. When we get back into the bear market, some of those individuals that come into the bull, they stay around. Although again, a lot of them do leave. But the kind of key takeaway is that like every bear market, that base of people who stay is higher and higher and higher. And when you're down 70 to 80% in asset, especially lately, right? I mean, we've got again a tremendous, and we can get into this in a moment. Tremendous amount of forced selling from basically every type of entity that you could think of in the space. You've got the worst macro environment that I've ever seen in my short little career in markets, and you've got all that kind of uncertainty. Who's buying down 70, 80%? These are people who are likely relatively, you have some traders that are perhaps looking for like a short-term mean reversion trade, but I would say the vast majority of it are likely, people who are relatively time insensitive and are looking to, accumulate this asset at a distressed price. And so that, when you're down 80, 85% at the bottom of every Bitcoin bear market, the people that are buying down there and the quote unquote, cohort of hands that the supply gets concentrated into are those who aren't going to sell most likely for a 20, 30% move. And that's what allows, these moves back to the upside to be so aggressive, in the same way that, the downside moves are so aggressive because the people that are buying, once the asset is up, 10x from the bottom, these are people that are, likely just going to get shaken out once number isn't going up anymore. So these dynamics really, cause a bit more momentum and fuel to the typical market cycles that you would see in Bitcoin. And again, some of it as well is there's been a lack, at least historically, of a way to kind of tie in Bitcoin to a fundamental valuation. I mean, I would argue some of the on-chain related stuff is the best way to do so that we have. But I do think that kind of exacerbates a lot of the fear and greed around just sold price action.
Talk a little bit about reflexivity. I've seen you tweet a number of different times about that concept, and maybe explain how you think about what is kind of a timeless investing idea, or at least one that's been around for a while now. Obviously, Soros and many others have popularized, and then why you're so interested in reflexivity when you're analyzing, the Bitcoin and crypto market.
Sure. So I've got this book on my desk right here. It's called The Alchemy of Finance by George Soros. And I know some people don't like George Soros for some non-financial related reasons. I would say, you can pull someone's ideas out, even if you disagree with other aspects of them. So I'm going to, not comment on some of those alternative reasons why people dislike Soros, but I do think from a financial markets perspective, he's got a lot of valuable insight. In the book, he talks about, in like the first 5 pages, he talks about this concept of reflexivity, kind of from a high level. And the way to kind of think about it is that price movements and actions in the marketplace reinforce these beliefs or behaviors. So, for example, as you think Bitcoin is going to be more widely adopted by, corporate balance sheets, right? And that's something that a lot of us thought in late 2020. We saw Saylor buy in, and then after that we saw Tesla add Bitcoin to their balance sheet at the beginning of February 2021. At the time, that reinforces that belief from market participants that you're going to see continued adding of Bitcoin to corporate balance sheets, and that extension of belief in optimism in the market gets extended because of the actions that are taking place, and it reinforces and further pushes out the expectations of market participants. And that happens conversely to the downside as well, where you have bad news events or events that are quite bearish, like some of the things we've been seeing lately with some of these blowups from different entities in the space that reinforce and continue to push people's expectations lower and lower and lower. And again, I think a lot of that in the Bitcoin and crypto market gets exacerbated because of kind of the lack of, saying, okay, well, Bitcoin is at this relative to its, free cash flows that it's drawing in. Again, I do think there's other ways to value Bitcoin aside from that, but I think that, the sensitivity to basing Bitcoin's value off of price action really kind of extends out some of those effects of the reflexivity in the marketplace. A lot of people were talking about, over the last 3 years, the concept of the super cycle, which I personally never bought into. But the reason why was really eloquently stated by Light. So there's this guy, Light Crypto. He's supposedly a prop trader on Twitter. He's anonymous, but I think he's got a lot of insightful things to say. And he went on a podcast actually at the Pico top of last year, and I was listening back to it last week. And one thing that he said that basically ties into what's stated by Soros is that although an asset can go through a super cycle, and obviously not a whole lot changes fundamentally with the Bitcoin protocol, but the infrastructure around it does change, evolve, and mature. But the other crypto assets, you have new innovation, whether they need whether they're decentralized or need a token. Like, that's a whole nother discussion I don't want to get into, but like, I would say that the utility of something like a MakerDAO or Uniswap is better than the garbage that was around in the 2018 ICO craze. So you have increasing utility of the underlying technology, and again the infrastructure around Bitcoin, and that can go through a super cycle. But what does not change is the underlying human behavior and the kind of psychological dynamic of fear and greed that drives markets. And no matter how strong the improvement of the underlying technology can be, that doesn't mean that humans will not always continue to push out expectations further than the underlying value is, no matter how strong it is. And conversely, to the downside, no matter how bad things get, humans will always push expectations lower than they actually truly should be, because of kind of that dynamic that Soros talks about.
So when you take that idea and you look back over the last couple of weeks with all the contagion, the unsecured lending, just all kind of the chaos and uncertainty there, how do you think through what was like mechanical in the industry of just like, yes, this was very obviously going to unwind, versus what is more like psychologically driven or kind of fear and uncertainty driven, where there's people actually panic selling and doing that? And the reason why I ask kind of backwards looking is I think it's really hard to understand what's going to happen in the future, but at least if we do analysis on the last couple of weeks, what would your kind of process look like there?
Yeah, I mean, the fear side is a bit more difficult because it's not quantitative, but like, I mean, to start, so when we look at what's taken place with all these crypto lenders, right? I mean, a lot of this has been people seeing that, okay, perhaps maybe this platform that I'm using is insolvent, or they have some mismatched assets and liabilities. I'm going to pull my assets off the platform, and so essentially we've seen kind of a classic bank run style event take place on some of these platforms. And also, by the way, that's reflected in the on-chain data. When we look at like exchange outflows from centralized platforms, we've seen the strongest amount of exchange outflows in Bitcoin's history, like straight up. And whether I think the market's gotten a bit more nuanced to say whether that has like direct price related effects. I would say that I think that's a reflection of in recent times just kind of the hysteria around people questioning the solvency of any centralized entity in the crypto space, and is also why Bitcoiners advocate to say, not your keys, not your coins. So that's one example of perhaps maybe some of these entities did have bad debt, but then on top of that you had users withdrawing their funds because they became concerned around a lot of the contagion effects, and that perhaps exacerbated some things. But I mean, look, I think again, and now I guess we can get into this stuff in a bit more granularity, but like there's been a lot of forced selling that's taken place. Let's just start with this one chart. So I'm not sure
Which
if
one?
Jordy has the newsletter up. Let's look at so it's the correlation of Bitcoin's market cap and ETH's market cap to the crypto market cap. It's like the third chart
Yep.
down in the newsletter. All
and,
right, cool.
And this one shows the market cap of Bitcoin and the market cap of ETH at top, and then the correlations kind of going down, right?
Yeah, exactly. So we're looking at Bitcoin's market cap plus Ethereum's market cap, and then we're running a correlation of that to the crypto market cap, excluding Bitcoin and ETH. And so, as most people in the space know, Bitcoin and ETH are really the two most liquid assets. Of course, there's Tether and USDC, but those aren't directional assets. Bitcoin and ETH are really the only two liquid crypto assets in the space. And so what's interesting to me about this chart is when you see this decline in the correlation, it's pretty strange. It's like probably like the most aggressive decline in correlation that you've seen between these two in a long time. What I think this is representing is forced selling. And the reason is because, in an event like this where, either you have, recently we just finished out the second quarter. So you have not only the end of the quarter, but also the end of the first half of the year and the end of the month, like all three of those things. Perhaps you have some fund redemptions taking place. And then you can also have, some of these lenders concerned about the solvency of all their counterparties. So they're asking them to post collateral just to, see if they do have the assets that they're claiming to have. All these kinds of things perhaps are forcing people to, trim off holdings in assets that, they have to trim off, not assets that they necessarily want to trim off. The only assets that really have, liquidity to absorb large outflows are BTC and ETH. A lot of these altcoins just really are just getting all the liquidity in them dried up. So, even if you want to exit a position, you really can't do so without, having a material effect on the price. And then on top of that, let's say you're like a VC invested in some project from some seed stage, you're not going to really want to drive the price down 70% because that's just going to really hurt your reputation as a VC. So I think a lot of these things have kind of added up to seeing this, what appears to me as a dynamic of forced selling of the two most liquid assets in the space.
So when you start to look at something like this, let's then overlay it with Murad in his much anticipated return to Twitter. He started to post this graphic or this chart, and what he shows is the Bitcoin USD trading pair, and then he shows the total amount of Tether and USDC. And they appear, at least visually, to be inversely correlated. When Bitcoin goes down, it appears that there's more stable coins there. Is it just that simple? Like there's an inverse correlation or no?
Yeah, so what this chart is essentially comparing is just the total crypto market cap to USDT and USDC, which are the two largest stable coins. And so kind of the concept behind this is that whenever you get to kind of the upper bound of this ascending channel, that means that there's a large amount of capital sitting in stables versus being deployed in the crypto market. And then whenever you get to the bottom end of the channel, what that is showing you is that there's a large amount of capital deployed into actual liquid tokens relative to the amount of kind of dry powder through stable coins sitting on the sideline. And as you'll see, we're kind of around that question mark. What Murad is essentially kind of hypothesizing in this chart is that you've got a large amount of assets sitting in dry powder via stable coins relative to being deployed in the crypto market. And as you can see, sometimes we kind of hang out on that upper bound for perhaps a month or two, but generally speaking, whenever you're pushing up against that upper bound of the channel, that's then a good time to accumulate. And part of moves is not necessarily it's people like being on the sideline and not being in the market and then forcing them to chase. And I would say there's a fair amount of people, because of a lot of the uncertainty, that are waiting for the market to show them strength to get back in. So that's just something to kind of put this into context with perhaps as if the market did move up, you would see people want to wait for that confirmation to get back out of stables. But for now, you're seeing a large amount of dry powder that's kind of sitting on the sideline relative to being deployed in the actual market.
Got it. You also recently put out some charts around the Bitcoin 4-year trend, and you identified that 4-year trend, Bitcoin is trading below it for only the 4th time ever. How important is that? Like only 4 times in the history of Bitcoin sounds like it's super, super important, but how do you evaluate this?
Sure. I mean, when we talked earlier about, how do we value Bitcoin? I would say there's two real ways to do so. One would be looking at kind of the underlying like fundamental dynamics via on-chain, what's going on with miners, those types of things. And the other would be more price and trend related. So what this is looking at is the latter. So we're looking at the 4-year price trend of BTC. We've seen Michael Saylor post about this. And then when we look at, I kind of unselected these other metrics in the chart, but you can also look at the number of standard deviations from the 4-year trend. That's been kind of a good signal to see where Bitcoin's peaking out. But this 4-year trend is historically served as kind of this support area for Bitcoin in bear markets. When we look at 2015, 2018, 2020, and then as well recently we're below it. It's just again the 4th time ever that we've gone below. I think the question when we look at a lot of these metrics, across the board is, these are all in like these deep value levels, but the argument to be made is like, is this time different because of kind of the macro backdrop? I don't know. Obviously, I don't, no one knows. Time will tell, but I think, at least from, a long-term investor's perspective, it's a good time to start, putting some dry powder in the market and, starting to average in a bit here at these kind of levels that historically, marked Bitcoin's at least, an accumulation and bottoming zone. Another good example is like looking at the next chart. This is basically the deviation from the 200-day trend. And then we also up there have realized price, which is like the average cost basis of all the investors in the market. Bitcoin's only ever traded below both of those for 3% of its existence. And a lot of that took place in that portion in 2011. And if you pulled that bit out, it would be even smaller than 3%. But it's just another, way to illustrate, we're at historical levels of what appears to be, cheap valuation, relative historical valuation for Bitcoin. I think one last, I guess, dynamic we could talk about is the dynamics with miners. That's been something that I think has been important to keep in mind lately. And it also kind of ties into a lot of the forced selling that we talked about has been taking place. So for several weeks now, we've been putting in the newsletter essentially that you're seeing favorable conditions for miners to starting to have to unplug. I tweeted about a month ago that I said, lower Bitcoin price, higher hash and difficulty, and higher energy costs have put serious pressure on miner margins. Hash price is now the lowest since October of 2020. Hash ribbons have crossed, and I'll talk about what all this means. Hash ribbons have crossed, indicating machines unplugging and miners sending Bitcoin to exchanges. So what's been taking place is you have this kind of delayed effect historically with hash and price. So, there's a delay in when you order ASICs and when you're actually able to plug them in for a variety of reasons. But, if we go back and look, the most recent before now was, 2017, 2018, you saw Bitcoin's price peak at 20K and actual hash rate, didn't peak until 2, 3, 4 months after that. And what happens is like miners are essentially, the way you can think of it is they're long Bitcoin price, short hash rate, and thus short difficulty as well, which is a byproduct of hash rate. And so what happens is like the price is going down of Bitcoin while it's becoming increasingly competitive to get the same miner revenue. And so what you can look at to illustrate this is something called hash price. So this compares miner revenue and Bitcoin's price. And hash price is at the lowest that it's been since mid to late 2020. So it's just showing you, I think hash price is a good way to kind of illustrate the compression of minor margins. And then you throw on that, we've got, inflation at 40-year highs. And a lot of that has been driven from energy costs. So you've also got, higher energy costs, which is miners' biggest operational expenditure that they have on top of that. So, all that puts together kind of the perfect recipe for a lot of minor margin compression. And so at the time of posting this, like a month ago, you had saw hash ribbons, which are looking at the 30 and 60-day moving averages of hash rate starting to cross, which had illustrated that you're starting to see some machines getting unplugged. Now we've seen confirmation of that cross, and we've seen the 30-day cross pretty significantly below the 60-day, which is showing you that machines are starting to get unplugged. And then on top of that, we've started to see over the last month, especially after I posted this, inflows of BTC from miners to exchanges. And then kind of the cherry on top was over the last few days, we saw Core Scientific selling off 7,202 BTC at an average price of $23K, which comes out to about $167 million that they had to liquidate. And so, the dynamics that we're seeing here with miners have taken place before. You had Nick Carter on about a month ago, and he talked about how, miners are a really pro-cyclical force for Bitcoin. So, they hold their assets in the bull market. And then as, you kind of see that turnaround and all the dynamics that we just described, hash continuing to come online while price is coming down. And then you throw on now the rising energy costs. Those margins really come under pressure, and the inefficient miners that don't have access to the cheapest energy, they have to, at a minimum, unplug their machines, at a worst case, liquidate their operations. And so I do think you've seen a lot of that. And, as long as Bitcoin's price hangs out down here, and if it does go lower, then you'll see continued pressure on some of those miners. And I do think you'll see some consolidation of miners who perhaps got a bit too greedy and didn't manage risk as well as others over the last 2 years.
I think that as people wake up to what's happening, obviously in hindsight, it's very easy to kind of identify all of this stuff, right? And be like, hey, this is why this is occurring. And right now, it's super valuable to people because they're starting to realize, okay, the price doesn't just magically go up. The price doesn't just magically go down. There's actual things that are driving that price. And once they start to understand what's happened, they start to see how complex and intertwined so much of this is. Everything from the contagion to the miner selling, the price, the difficulty adjustment, the cost of electricity. Like there's just so much of it that is interrelated. Before we let you go, where can we send people to find you on the internet or subscribe to the Blockware newsletter?
Sure. No, thanks, man. I'm on Twitter at WClemente. I appreciate you having me on. I try to put on the dress shirt to get on your level with the suit. We got to do what we got to do here in this bear market. You could check out the newsletter. It's in my bio at blockwareintelligence.com if you're interested in anything that I said.
You own a suit and tie?
I do. I have one.
Yeah, I have one too. This is the only one I have, and I wear it every day now until the bear market. We got to get the bear market over. John laughs all the time because he's like, we got to get this over because he's tired of wearing the suit and tie already.
Where's John's suit?
John is
I'm right here in a t-shirt.
John's too smart to have signed up for the suit and tie.
I was going to say, Will, the Patagonia makes me think you're joining Wall Street.
Man, I went to New York 2 weeks ago, and I went and met someone in like the financial district. And I was walking through, and I saw Bill Ackman walking around, by the way, and I was trying to get him to buy our internet Ponzi, but he wasn't interested. I saw a bunch of the guys walking around, like, the JP Morgan building, the BlackRock building. and they were all wearing this vest. And it was after I bought it, I was like, oh God, like I'm really like a finance bro now that I bought this thing.
That's the uniform. If you don't got the uniform on, then you're in violation. All right, buddy. Sounds good. We'll talk soon. We'll do it again next Friday.
All right. Thanks, guys, for having me on. Take care.
That was a great conversation with Will, and I really enjoyed it. Don't forget that these episodes are brought to you by FTX US. You can go click on the link in the description. FTX sometimes has cheaper fees, as much as 85% cheaper than their competitors. On top of that, they also offer digital stock trading in beta, which allows you to go buy various stocks in-app that doesn't have any transaction fees, and there's no payment for order flow. As FTX US continues to build out their offering, I think that they are going to become the preeminent brand in crypto trading in the United States. Go check them out by clicking on the link in the description and let me know what you think. That's it for this week. I hope that you guys enjoy these updates every single week, and we'll be back next Saturday to give you more information then.